company's ROIC converges to its cost of capital, at that point, is the assumed value of the company equal to the accumulated assets? Like you're now in a like liquidation value for that company?
Okay, that's a very subtle but great point. So what happens is once you get to the point that the ROI is equal to the cost of capital, present value of future growth is zero, right? So you don't have a perpetuity issue with the value of the firm. Once you get to ROI is equal to the cost of capital, they can grow all they want, and they're not going to add any net present value back to the firm.
Right.
So the valuation problem, getting back to, this is where I think valuation is very subjective, and a lot of people have problems with the subjectivity. Now, I grant you, we made a lot of subjective assumptions back in 95 and 96 and 97, but we let them run now. So when you get into, I'm going to take this company and I'm going to grow its sales 7.8% next year and 9.6% the year after, and then I'm going to fiddle around with the terminal value assumption. That to me is what people think of with subjectivity and valuation. Traditionally, I think that tends to be the biggest criticism. Now, we do this with the economic margin. We also do this with the implied growth rate, the growth rate that we use. And the growth rate that we use, we take from what the company's telling us in terms of its capital structure and its dividend and share buyback and debt buyback policy. So we kind of let the company tell us what it's doing with its cash. Is it returning it or is it reinvesting it? The end result, let me just show you Micron from a different perspective. If we can pop this back up and then we can kind of take this into any direction we want. Mm-hmm. This is the way we look at the world. And we've done this since 1998 every week, and we do it for 20,000 stocks around the world. We take 1 point estimate of where the economic profitability is today. We have 1 point estimate for what that economic profit horizon is. We have 1 point estimate for where we believe their capital growth is going to go, and we combine it with our current estimate of company-specific cost of capital that we can certainly dive in as much as we want. But kind of the interesting thing here is as we were transitioning from management consultants to equity analysts, we had that little thing called the tech bubble back in 2000, 2001. And so we would approach people and say, Cisco's trading at 85. It's really worth 14. You can imagine, I think we literally got a death threat in our office once. We sent out a report to anyone, any email address in the research, in the money management industry we could find. One person literally wrote us back saying, you guys should just be dead. You're so stupid. I'm like, whatever. That's our estimate. That's what we believe.
That's when you know you're right, mate.
Yeah.
Maybe.
Well, you might have been wrong. Well, wrong, right, whatever. But for $14, $2.85. Obviously, correct. That's where the vitriol is coming from.
Correct. Absolutely. No doubt about it. This is Micron. You see the same pattern, right? It was trading up around 60. We thought it was worth about 10. And so the blue bars represents the annual trading range for the year. The little horizontal slash is where it closed. That solid line, and again, we do this weekly, but this is just kind of an annual point estimate, is what we think the stock is worth at any point in time. So for Micron, no one wanted to talk to us. People thought we were nuts. It took until about 2006, 2005 for Micron's traded price to converge to its intrinsic value. More or less, it stayed there until 2015 when we bought it at like 16 and it immediately dropped to 9. But for us, one of the things that we think is interesting is we've scored our intrinsic value model live for 20,000 stocks globally every week. So when we see a situation like this in 2016, where the stock price continued to drop and the intrinsic value is not moving, we had a lot of confidence in what we were doing. I mean, we've seen these shows over and over again. And once we had an analyst kind of confirm this company is not going out of business, there's just a lot of bad sentiment. It's like, okay, that's fine. We have a number, we have some of our products are purely quantitative. That Valuation 50 product is a quantitative qualitative. It has that uses our intrinsic value as the main sorting mechanism, and then analysts work with our model to generate their own estimates of intrinsic value, incorporating information we don't have. So again, our view of value is very different. We believe value is an absolute concept, and it should be treated as such, as opposed to kind of this conflating so many different factors into a cheapness concept. Perfectly fine for people to invest with cheapness, and a lot of brilliant people do it. We just don't think that's the right way to do it. And we certainly don't think that should be what's called value investing by any stretch of the imagination.